one thing that sort of has me, with respect to Bitcoin specifically, that has me sort of concerned about anticipating that's going to spill over into Bitcoin in the context of this kind of store value discussion is the fact that we have a halving next spring, right? I want to say in April or May of 2024. And obviously halvings tend to be this, very, very bullish event for Bitcoin. And at least that's what I thought initially in my speculation. So I'm sitting here thinking, is Bitcoin even going to go down in this phase 2 credit cycle downturn? Let's say the SPY gets to, down 20% from here, it'd be like 3,200 or something. Does Bitcoin go to 17.5 again, or does Bitcoin stay where it is, or even appreciate, because that'll be very close to that, springtime halving? So I did a little work, this morning, kind of trying to identify, okay, is there a history of volatility in Bitcoin heading into the halvings, or is the halving the catalyst for the kind of record appreciation on the other side of that? And the results of the study that I did suggest that there tends to be a lot of volatility in the year into Bitcoin. I can just read these off, sorry to not have these off the top of my head. I'm usually better than this, but, so into the November 2012 Bitcoin halving, we saw a minus 39% max drawdown in February of 2012. And so I'm looking at the year prior to the halvings. And we saw a minus 27% drawdown in August of 2012. In the July 16 halving, we saw a minus 30% drawdown in August 15. We saw a minus 25% drawdown in November 15. We saw a minus 20% drawdown in February 16, and we saw another minus 20% drawdown in June of 16. And then lastly, into the May of 2020 halving, we saw a minus 48% drawdown into December 19, and then another minus 53% drawdown kind of during COVID in March of 2020. So that's a lot of crashes, man, in the year leading up to the halving. And so I just want to put that out there and say, hey, look, I know this is going to be a very positive event. I think if we're having this conversation 18 months from now or 20 months from now at the end of 2024, Bitcoin's probably at 200,000, if not higher. And I definitely would fully buy into that view. It's just the path to getting there, if you're trying to build a big position to take advantage of that, is likely to be very volatile. At least that's what history suggests.
In less than a year, the Bitcoin mining reward will be cut in half. This will be a major event for anybody following the cryptocurrency industry. Bitcoin's price has increased by hundreds of percent in the 12 months after each halving. When supply is cut in half, but demand stays the same, it inevitably puts upward pressure on prices, and the market has to adjust to this new equilibrium. At today's pricing, the halving in 2024 is expected to wipe out almost $5 billion in Bitcoin value. The scale of the Bitcoin halving and its possible effects on the cryptocurrency market are thus made clear. But before you go and invest your whole life savings in Bitcoin, there is a lot of statistics showing why you shouldn't. Darius Hale, CEO and creator of 42 Macro, explains in his latest podcast why Bitcoin has typically had massive price drawdowns in the 12 months before to the halves, providing investors with a fantastic buying opportunity before the halving bull run. Watch till the very end to hear Darius's predictions for the Bitcoin halving, including how high the bull run would go and when he would start purchasing Bitcoin.
Yeah, the key takeaway I'm trying to make is we don't know, but we assume Bitcoin is probably going to be very much higher in price in 20 months. The problem is, if you're buying it today at 30,000, you need to be aware that, hey, there's a long time series history of these material drawdowns, very significant drawdowns, capital destroying drawdowns into that event. And we also have this phase 2 credit cycle downturn that is completely separate and apart from anything that's going on in the cryptocurrency ecosystem. So as a risk manager, and that's kind of what our clients, kind of task us to do with 42 Macro, the number one thing we're trying to preach right now is patience and prudence. We're not trying to get people to run out and short Bitcoin or short the stock market. What we're trying to do is have them understand, hey, look, there's going to be a better buying opportunity ahead of us, probably sometime in the next, call it 2 to 3 quarters, and take advantage of that buying opportunity. But between now and then, the goal is not to get rich quick, it's to get rich smart over a longer period of time. I think this asset class is going to be, for a long period of time, fraught with sort of exogenous events, whether it be regulatory. I mean, mostly regulatory. Obviously, that was a regulatory event in China. We're not the only ones who can regulate, by the way. But this is, I think the underlying message of the resiliency of the asset class. And I don't necessarily mean resiliency from the price appreciation standpoint. I mean resiliency from the perspective of this thing ain't going anywhere. Right? Like we had FTX and Celsius and Luna and all this other stuff happen in the last kind of 12 months. And not one time did I see anyone really question the longer term viability of Bitcoin. throughout this entire process. I mean, we've seen people blow up and left and right, put in handcuffs left and right, and and to me, so I'm very proud of the asset class for that particular perspective. I think, just from a risk management perspective, I think, there's the path to getting to this, rainbow and puppy dog type outcome is, you got to walk through the hood for a little bit.
What are the institutions doing right now? Are they mostly in cash? Are they looking at Bitcoin or cryptocurrencies? Are they in equities, oil? Like, where are they kind of tactically looking?
So that's a phenomenal question. So I'll bucket this into different categories of institutional investors. There's sort of your long only kind of, just longer term, 12 to 18 month time horizon on any holding style investors. Those are your kind of large mutual funds, pension funds. And then you have your sort of, kind of hedge fund oriented strategies. These folks tend to, they kind of generally need to be making money on a month to month basis at the bare minimum, not having, drawdowns in excess of 3 to 5%, particularly these large multi-manager market neutral players. The latter category, these market neutral pod shop type hedge fund vehicles, to a man, woman, and child, everyone I talk to, and we have, many clients across the space, they are all trading with a higher frequency than they ever have in their entire career. Like the short-termism in that community of investors has never been more like ferocious. And I think that's part of like why, ignore Bitcoin for a second. Just look at the chart of the S&P 500. Since May of 2020 of last year, it's gonna almost be a year. We've been bouncing around more or less between, let's call it 4,200 and 3,800. We went to 4,300 in August, and then we went to like 3,500 in October. But for the most part, we've been flat. You pull up a year-long chart of the S&P, it basically hasn't gone anywhere. But what it has done is been very violent. We've seen like a 10% rally, then a 15% drawdown, then a 20% rally, then a 10% drawdown. These are like annual returns. So we've had like 5 or 6 years worth of returns to carve out if you're a good trader, if you're a good active manager to take advantage of. So that community of investors is extremely kind of narrowly focused on, kind of what's really happening right in the here and now. And that concerns me from a medium-term perspective because their foresight on, the phase 2 credit cycle downturn, some of these longer term, like kind of macro cycle risks that I think, we're likely to start to rear their ugly head and towards the back end of the year. I just don't think you're going to have enough investors focused on that, which will allow you to have kind of a market crash style outcome. When you're talking about the long only institutional money managers, everyone is positioned for down dollar, short the dollar, and every derivative trade of shorting the dollar, whether it be improving global growth, whether it be emerging market outperformance over U.S. equities, whether it be commodities over, hard assets, commodity physical assets over digital assets. We've seen a little bit of a crowding back into the tech space, but by and large, those investors, and I've been having these same conversations really for the past kind of 4 or 5 months, which is, how do I take advantage of down dollar, up global growth without actually just being long China, but given all the regulatory and geopolitical concerns that are emanating out of that economy. So there's a lot of consensus across, kind of what I would consider traditional Wall Street right now, whether it be just like knife fighting for, basis points on a daily, weekly basis, or whether it be just, short the dollar. Both of those things, I think, could be proven very wrong. You get to kind of 1 to 2 quarters from now, maybe not 1 quarter now, but certainly I think by the end of Q3, this concept of down dollar, everything up global growth, I think will fall by the wayside. At least that's what our models are suggesting. And then the concept of, I don't really have to worry about medium-term risk, being in the right exposures from a medium-term perspective in the kind of the shorter-term pod shop exposures or head managers. That to me is a big worry for me, because again, when you get into the back half of the year, everyone's going to start to recognize the deterioration in the labor cycle, kind of, okay, we actually might be heading into recession, but they can't all get out of the same pipes at the same time. You can't all go buy Procter & Gamble at once and sell everything else you own, because this is how markets crash. Markets are they've been very illiquid for a few years now.
If you enjoyed this content, please give us a thumbs up and subscribe to our channel for more informative videos. Stay tuned for more updates on the world of finance, investing, and economics.